In the world of trading and investing, people often look for certainty where there is none. They search for signals, indicators, and strategies that promise an edge, hoping to find a shortcut to predict the future. Charts fill up with moving averages, oscillators, MACD lines, RSI readings, and countless other tools designed to provide guidance. Yet, despite the complexity of these tools, the truth remains simple and unchanging. Price is the only indicator that is truly unbiased, and it alone reflects the genuine intent of the market. Every other tool, every calculated signal, and every technical construct is a reflection of past price behavior. They can be useful, but they are derivative, secondary, and often subject to interpretation, bias, or delay. Price, however, tells the story directly, in real time, without embellishment or opinion. It is raw, unfiltered, and immediate. When we observe price, we are not merely watching numbers on a screen. We are watching the collective decisions of millions of participants, each reacting to news, emotion, and circumstance. Price is the manifestation of human behavior in its most distilled form. When the market rises, it does so because buyers are willing to pay more than sellers ask. When it falls, it does so because sellers are willing to accept less than buyers demand. There is no guessing, no hidden agenda. The rise and fall, the pauses, the reversals, and the accelerations are all messages written by human action. Unlike indicators, which calculate and smooth, and unlike predictions, which project hopes or assumptions onto the future, price communicates directly what the market wants, what it fears, and where it is likely to go next based on collective behavior. One of the most powerful aspects of price as an indicator is that it is unbiased. It does not care who you are, what you believe, or what your expectations are. It does not adjust to favor the optimist or punish the pessimist. Price moves according to supply and demand and reflects the consensus of value among participants at any given moment. This lack of bias is precisely what makes it so valuable. Indicators are only as objective as the assumptions behind them. Moving averages require a look-back period. Oscillators have thresholds, and algorithms embed human decisions into their logic. Price has no assumptions. It reacts and reflects. By paying close attention to price, you are listening to the market in its purest form. Understanding price as an indicator requires a shift in perspective. Many traders attempt to forecast the market based on predictions, patterns, or external events. But price is not merely a response to external factors, it is a statement of consensus. It reveals whether buyers are confident or hesitant, whether sellers are dominant or retreating, and whether the market is balanced or poised for a move. By observing these shifts in behavior, one can interpret the underlying intent. For example, a sudden surge in price with high volume indicates decisive action by buyers. A failure to break a prior high shows resistance and caution. A sharp drop followed by a rapid recovery signals resilience. Each movement is a clue, a piece of evidence that tells you what the market is thinking and feeling. Another essential quality of price is that it communicates habitually. Market participants are humans, and human behavior tends to repeat. The patterns in price that emerge over days, weeks, or years are not random. They are the result of consistent behavior among buyers and sellers. This repetition allows observers to recognize tendencies and anticipate probable outcomes. By learning to read these habits, traders can align themselves with the market's intentions rather than fighting against them. Indicators can lag, mislead, or overcomplicate, but the raw action of price is immediate and faithful to the reality of supply and demand. Finally, price teaches discipline. It rewards patience and observation, not opinion or hope. Those who rely solely on external indicators or predictions often find themselves acting prematurely, chasing signals that have already been realized or reacting emotionally to noise. Those who focus on price develop the ability to observe without bias, to wait for confirmation, and to act in accordance with what the market actually demonstrates rather than what they wish it would do. Price provides the truth, untainted and straightforward, and mastering its language is the foundation of understanding market intent at the deepest level. Markets are not abstract machines. They are reflections of human thought, emotion, and decision-making. Every tick, every candlestick, and every swing in price is a manifestation of collective human behavior. Understanding this is crucial because it is human behavior, not chance or randomness, that drives the patterns we observe in markets. People react to fear and greed in predictable ways, and these reactions create repeating sequences in price movement that can be studied, anticipated, and understood. Unlike artificial indicators, which are constructed tools designed to measure or smooth past data, price patterns are direct evidence of psychology in action. They are the footprints of human intent left on the market. When we study markets, it quickly becomes clear that human emotions do not change with time or geography. Panic, optimism, hesitation, euphoria, and doubt have existed in markets for centuries, and they continue to manifest in the same ways today. A sudden drop in price triggers fear, causing a cascade of selling as participants react emotionally. Conversely, a rapid rise incites greed, attracting more buyers, pushing prices even higher. These emotional reactions are consistent, and because humans repeat their psychological tendencies, price forms patterns that also repeat. Recognizing these recurring movements allows traders to interpret the underlying human behavior and respond accordingly, rather than merely reacting to numerical fluctuations. Patterns like trends, breakouts, reversals, and consolidations are not random. They are born from the natural habits of crowds. When prices consolidate at a certain level, it is often because buyers and sellers are in equilibrium, uncertain about the next direction. When a breakout occurs, it is the result of human decisions tipping the balance, forcing action from one side or the other. Reversals happen when an imbalance created by overconfidence or panic corrects itself as participants reassess value. These movements are predictable not because the future can be calculated, but because human behavior follows a rhythm, a recurring cycle of emotion and reaction. Every swing tells a story of sentiment, hesitation, confidence, and error. Volume, speed, and the size of price movements also reflect behavior. Rapid surges indicate decisive action, while slow, hesitant moves show indecision. Markets with high participation often exaggerate emotional extremes, creating patterns of sharp peaks and valleys. Those who learn to read these signs do not rely on arbitrary indicators or models. Instead, they observe the market itself, recognizing how human psychology unfolds in real time. These insights allow for a deeper understanding of potential outcomes and better decision-making, aligning actions with observed behavior rather than speculation. Another aspect to consider is the habitual nature of human error. People consistently overreact, underreact, or misinterpret information in similar ways. These habits create predictable behaviors in price, which can be studied and anticipated. Support and resistance levels, trend continuations, and reversal points all emerge because of repeated responses to market stimuli. Traders who understand that these patterns are a reflection of human behavior can see opportunities where others see randomness. They learn to anticipate reactions, respect the market's rhythm, and avoid being caught off guard by emotional extremes. Finally, recognizing that human behavior drives price patterns fosters discipline. Markets will always punish those who act impulsively or follow untested assumptions. By focusing on behavior, traders train themselves to wait, observe, and act in accordance with what the market demonstrates, rather than their personal biases or wishes. Price patterns are reliable not because they guarantee success, but because they are faithful reflections of repeated human behavior, the only constant in an otherwise uncertain environment. Understanding these habits allows traders to align themselves with the natural rhythm of the market, rather than fight against it, creating a foundation for consistent and informed decision-making In the world of trading, one of the most common mistakes is acting on what we hope or expect the market will do, rather than what it actually does. Expectations are built from assumptions, desires, and sometimes wishful thinking, but the market has no obligation to conform to anyone's beliefs. Price does not care about predictions, theories, or personal opinions. It moves based on supply and demand, reflecting the collective decisions of all participants at any given moment. Observing how price reacts at key levels provides insights that no forecast or indicator can replicate because these reactions are direct evidence of market intent. The ability to watch and interpret these reactions is the cornerstone of understanding price action and trading with discipline. Key levels in the market, such as previous highs and lows, support and resistance, round numbers or trend lines, are not arbitrary. They are psychological landmarks where market participants often make critical decisions. When price approaches these levels, it encounters an accumulation of past decisions, orders, and expectations. How it behaves at these points reveals the balance of power between buyers and sellers. A breakout through resistance indicates dominance by buyers, while a failure to breach the same level signals caution or weakness. These reactions are far more reliable than predictions, because they are born out of actual market behavior, not theoretical constructs. The challenge for traders is to observe objectively and not impose their own expectations onto the market. It is tempting to anticipate a breakout when a price nears a high or expect a reversal at a perceived support level. Yet markets often behave unpredictably when influenced by collective human emotion. Price may hesitate, retest, or reverse in ways that defy expectation. But these actions always carry meaning. By focusing on the actual movement, the hesitation, the acceleration, the failure, or the confirmation, traders gain a truthful insight into the prevailing sentiment. Observing price, rather than predicting it, allows for decisions based on evidence, not hope. Volume and momentum provide additional context to these reactions. A level tested with high volume and decisive movement indicates conviction, while a shallow approach with low volume signals hesitation. Observing these subtleties requires patience and discipline, as it often demands wading through periods of indecision. Many traders act prematurely, entering positions based on anticipation rather than confirmation. Those who wait and watch price respond to key levels gain a significant advantage because they align themselves with actual market behavior, reducing risk and improving the probability of success. Repeated observation of how price reacts at key levels also teaches valuable lessons about human behavior. Market participants tend to respond in consistent ways, driven by fear, greed, and herd mentality. Breakouts often occur when the majority finally yields to conviction, and reversals appear when overconfidence or panic dissipates. Recognizing these tendencies allows traders to anticipate potential market moves without guessing. By interpreting actual reactions rather than expectations, one learns to navigate both calm and volatile markets with clarity and control. The most successful practitioners understand that the market does not owe anyone a specific outcome. Acting on expectations often leads to frustration, losses, and emotional decision-making. Instead, observing price reactions instills a disciplined mindset. It teaches patience, humility, and respect for the market's natural rhythm. By focusing on what is happening, how price reacts to pressure, resistance, and support, rather than what one hopes will happen, traders develop an intuitive understanding of market dynamics. This is the essence of mastering price action. It is not about predicting, but about interpreting, responding, and aligning oneself with the truth the market provides. Ultimately, watching how price reacts at key levels transforms trading from an exercise in guessing into a study of behavior. It emphasizes evidence over assumption, observation over expectation, and discipline over impulse. By consistently focusing on actual reactions rather than imagined outcomes, traders learn to read the market's intentions with clarity and precision, creating a foundation for informed and strategic decision-making that aligns with reality rather than hope.